The last few years has been profitable to follow the herd, but is it time to break away? Today's guest thinks so. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. I'm Bryce with my co-host Ren, and today Ren is speaking with an investor who is trying to sound the alarm around the lack of diversification in a lot of investors' portfolios and what we can all do about it. Ren, good to be with you.
Bryce, good to be with you. Very excited for this one. It is a one-on-one interview, Alec on Alec.
Yes.
Today, I'm joined by the portfolio manager of the Orbis Global Real Return Fund, Alec Cutler. You were kicked out of the room, Alex
right.
only. I found this conversation fascinating. I guess the headline is common mistakes and their simple fixes. Because one thing that we've learned over and over again through doing Equity Mates and now doing Basis Points is that investing is as much behavioural as it is financial. And there have been some big cognitive biases or behavioural mistakes that I think a lot of investors have made. And to be honest, it's been pretty profitable to make them. You mentioned it's been profitable to follow the herd. As long as you're following them into big US tech over the last 10 years, you've been pretty happy. But the world's changing.
It is.
The markets are fracturing, and it's time for us to look in the mirror, recognize our mistakes, and do something about it.
That's it. Well, I'm looking forward to listening. Before we jump in, a huge thank you goes to our launch partners for here at Basis Points, Cboe, Milford, and Orbis. But today, a special thank you goes to Orbis.
For over 30 years, Orbis have been focused on finding global stocks that are undervalued or overlooked by the market. Their approach is all about the long term, looking beyond short-term performance to identify companies with real potential.
With a team of 60 plus investment professionals worldwide, Orbis sticks to a contrarian investment strategy. Managing over $60 billion in assets, their focus on value can offer a great way to add diversification to client portfolios, especially in today's ever-changing market.
So thank you to Orbis for sponsoring this episode and helping us keep all of our content free here at Basis Points. One final reminder before we get into the interview, this episode has been accredited by the FAAA for CPD points. So if you're an advisor, head to the YouTube description or the podcast show notes, click the link, complete the quiz, and we'll email you your CPD certificate. And Bryce, speaking of emails, one other exciting thing and important thing that we've got to share is the Basis Points email is now live.
That's right, Ren. Every month we'll send you insights from our community, the largest community of retail investors here in Australia and the next generation of wealth clients. So head to the link in the show notes to sign up so that you don't miss it.
All right, well, with that said, let's get to my conversation with Alec Cutler. Well, Alec, welcome to Basis Points.
Thanks for having me.
So we're talking today about, I guess, common investing mistakes and how we as investors and as advisors, we can sort of correct some of those mistakes. And I think one of the big things we've learned over our journey of investing is that investing is as much behavioral as it is academic. So what are some of the most common cognitive biases you see in investors today?
Well, so thanks for having me on to talk about mistakes, because I think I've made more than my fair share, having been around a while. First off, that is what we focus on as contrarian investors, is human nature and the pattern of mistakes that humans tend to make, that are ingrained in us since caveman days, and will be ever present. So any notion that we're moving into a new world where AI is going to fix everything, and it's just not gonna happen. Humans are humans. So just thinking about categorizing mistakes, one of the biggest ones that we find is time horizon. Investors tend to have a very short time horizon, which gives anyone who has a longer time horizon greater opportunity to identify a company that can recover over 3-4 years that's going to be passed up by the market. And because it's passed up by the market, we get the price at a much lower level. Another one would be herding. And I think we've seen a lot of that in recent years. So it's very easy to identify. Once something becomes popular, people want to be popular. They want to be associated with success. Again, that goes back to caveman times. You want to be associated with a thing that gives you protection or gives you some sort of status. And that can build on itself and build on itself and build on itself and create massive gradients in valuation and opportunity. And the opposite happens too. So there's unherding. anything that's unpopular becomes less and less popular. And as investors run away from it, the valuation gets cheaper. More people peel off because they're afraid of being wrong, but more afraid of being alone and wrong. You don't want to be the last one that's alone and wrong, because nobody wants to talk to you at a cocktail party.
Yeah.
And our job as contrarian investors is to really explore those names. And it can be rather tricky psychologically to do that and work against our primal instincts, but some people can make it work.
Yeah.
Not many.
Yeah. Well, I'm interested in following up on both of those. I think let's start with time horizon, because the challenge for a lot of fund managers is that they've got to report, quarterly and annually. And also for a lot of advisors who are listening, their clients are constantly checking the performance of their portfolios and constantly asking questions. So how do you at Orbis manage the expectations of your clients and sort of educate them around the importance of long-term investing and what that might mean in the short term?
We just don't give them short-term information.
Okay.
I'm kidding. We do a lot of education around the importance of taking a long-term perspective. We put it right up front in any literature that we create, and try and establish alignment. So if you're not comfortable with that, and if an investor is not comfortable with that, we don't really want you to work with us, because you won't be there very long. We will go through periods, months or quarters or even years of underperformance. And if you're not comfortable with that and you don't understand a 3 to 5 year time horizon, it's just not going to work. And in fact, it's going to be a negative experience, because you're going to come in during a good time or a neutral time, and you're certainly going to leave when things are tough.
Yeah.
So it is a big part of our client outreach.
Yeah. And then on herding, I think that's probably one of the biggest cognitive biases we've lived through over the past, 5 years. And really, it's been the Magnificent Seven. I mean, if you just rode the S&P 500 index over the past 5 years, at least before the recent correction, you would have doubled your money. And so everyone's just been piling in there. So for investors and for advisors who are now looking at their portfolios and are probably overly concentrated on a few names, how do you counsel those investors, and what's the effect on our portfolios?
Well, we play a game sometimes with clients and audiences. Are you diversified?
Okay.
And for a while, a couple of years ago, when ESG and socially responsible investing was popular and profitable, we would find clients that would say, I own 3 funds. I have an S&P 500 fund, I have a growth ESG fund, and I have a global ETF. And we put it up on the screen and say, okay, you're 47% in the Mag 7. Yeah. And the rest is large cap growth, U.S. large cap growth, with a little bit of smattering somewhere else. You are not diversified. And it's a role that we're readily able to play, especially when your practice area is contrarian and intrinsic value investing. That herding, when it gets to the ultimate asymptote of the peak, where we are and have been, that can be an incredibly valuable diversifier, because we are, what's called 95 to 97% active share. We have very, very little overlap with the quote unquote market, and if we're doing a good job, then that should add to returns and smooth returns long term. So ideally, you'd want 2 managers who perform such that they're one zigging when the other one's zagging, but they both produce great returns. The value of that combined return, say they both do 10% alpha a year, but one zigging and the other one zagging, the value of that, it will still be a 10% alpha outcome, but the smoothness of that would be much, much more palatable.
Yeah.
And therefore valuable.
Yeah.
So that's what we try to bring to the equation. We're not going to try and, outdo a large cap growth manager, which is kind of what everyone owns right now. We're just going to try and be the best contrarian manager we can be. And we provide great diversification when we do that.
Even in the contrarian investing space, I'm sure there are elements of herding, amongst your peers. I'm sure there are names that fall in favor and out of favor. So in your team and amongst the investing process at Orbis, how do you make sure you're controlling for that cognitive bias and not just getting caught up in the names of the time?
First, I think it's important to review how hard it is to be a contrarian and why, because I think that can help explain why being disciplined and consistent can separate us from the crowd even within value investing. If you think about, I try to relate everything back to when we were cave people. Investors have a short time horizon now because when we were cave people, you didn't live very long. And childbirth, I don't know if you're married with kids, but childbirth's an incredibly painful thing. And if you had a long memory of painful experiences as a human, the human race wouldn't exist, because the day after childbirth, my wife had no interest in having another child. So if each couple only had one kid, because that person giving birth to the child had a long time horizon in the memory, then the human race would peter out. In caveman times, being with the crowd was incredibly valuable because you stayed alive. The saber-toothed tiger couldn't take down a whole mob of cavemen, but it could certainly pick off one. So how do the contrarians do in that? How do the contrarians do wandering away from the crowd saying, I wonder what it's like being on my own? Maybe I'll go for a walk. Because that's a contrary thing to do. And you got eaten.
Yeah.
So contrarians didn't live very long. So it's a very rare trait, I think, certainly within investing or within business. And it's hard to do, and it's hard to maintain. For us, it's super important that we remain consistent, we remain secure in our ability to continue to be contrarians and intrinsic value investors, that the firm has the financial wherewithal to do that and the backing to do that, and that the firm structure is set up such that we don't have clients second-guessing us constantly or shareholders second-guessing us constantly. So that, to me, is the most important bit of being a contrarian, is having all the elements of support around you to enable you and encourage you to do that.
Yeah. So let's turn to the market, because one reason that herding has become such a dominant feature of the market today is simply because it's been so effective. But trends don't last forever. Charts don't go from bottom left to top right indefinitely. So, the S&P 500 has delivered 20% plus the last 2 years. Do you think this correction we're living through now is the first sign of the market actually changing, or do you think this is more... I guess what's your view on the current state of the market is the question.
First off, you don't have a gain until you realize it.
Fair.
So how many times have we seen, people get doubles and doubles again and wind up with a half? It is... history's replete with that. If we go to where we are now, are we at the beginning of that doubling, and then a half? We can't predict that. But if you think about the setup and just think about the facts and the math, the U.S. is the epicenter of overvalued markets, if you will. So the U.S. market at 24, 25 times earnings, it is priced for perfection. And I recall a period of time not long ago, speaking of short memories, where the justification for a 20p for the market was that we had the 10-year yield at 60 basis points. So the interest rates are so low, you should have a high multiple. Now the interest rates are back to something near normal, and we have an even higher multiple. Yeah. So what's the excuse now? The excuse now is effectively momentum. Yeah, things are going great. Margins are up. So price-to-earnings ratios can be up. In the normal world, it's actually the opposite. The higher the margins are, the more you're over-earning, and the market should be discounting that as good times, saying, let's use a normalized multiple and a normalized margin. But we're not. We are, I don't hear people saying American exceptionalism as much as they did a couple of months ago, but beware of the exceptional market, especially when it's really just exceptionally expensive, and nothing really has changed long-term. With regard to cracks and, what are we trying to find as a contrarian manager? We're looking for markets that are expensive or markets that are cheap. And then we're banking on, as my old boss used to say, good things happen to bad companies, bad in quotes, and bad things happen to good companies, good in quotes, because those two things are ephemeral. A stock that's down a lot tends to be a bad company.
Yeah.
May or may not be. And if you think about that in the context of the U.S., we've got a market that's priced for perfection. And is everything perfect? Everything has been fairly perfect, incredibly supportive. You've had a ton of money flowing into financial markets, either fiscal money or money from the central banks, creating money and shoving it in. You've had very supportive tax policy, very supportive regulation, very supportive administrations, where anytime there's a blip in the stock market, they come in with the cavalry of free money and try to prop the economy back up to get the market going. Those things are starting to be chipped around the edges. And, Trump, was the stock market's president. He's kind of fashioning himself to be the 10-year Treasury president right now. He and Besant keep hinting about a recession and how it might be constructive. One of the beautiful things about Trump is you can see what he's being advised because he walks out of the room and then tweets whatever his advice was.
Yeah.
So it almost seems as though there's been advice to have a recession now, have a bear market now, and blame it on Biden. And he's tweeting things like, this isn't really my economy or my stock market until 2026. That's what he's talking about. He's talking about, excuse me, I need to get this out of the way. And that'll help me get the 10-year yield down. And then we can dial back up the economy. And if you really want to worry about that 24 times earnings, these notions about what the administration can push and do on its own seem to ignore any kind of reaction function. It's almost as if they came up with it during the campaign in the bar and didn't think about ...
Yeah.
But you're seeing now, okay, we'll apply tariffs. Well, don't apply tariffs back. Don't react to that. Or we can make outlandish claims about Canada and Greenland and the Panama Canal and nobody will do anything. Well, the Canadians are pissed off. And it's hard to piss a Canadian off. Do you know any Canadians?
I do, yeah, and they're very nice.
They're very nice. How do you get a Canadian to say, I'm sorry?
I don't know.
You stomp on their foot. These are the nicest people on the planet. And now they've become anti-American.
They're certainly not. They've got their foot stomped on and they're not saying, I'm sorry now.
They are not.
Yeah.
No, they're stomping back, which is the point. They are reacting, and they're not reacting in the way that I think they anticipated during the campaign. And that is really important to understand, especially if you think about, well, we'll dial in an inflation, we'll dial in a recession, and then we'll dial it back up. We haven't had a big recession in a long time. And dialing it back up is not so easy because of human nature. We talked about before. It's people being afraid. And how do I secure my livelihood? Okay, I won't spend. I won't try and get a new, better job. I won't buy a new car. I won't have another child. I won't move into a bigger house. Economic activity drops and grinds to a halt because people get fearful. And often the only way it's very difficult to get out of it, it's often done with incredible stimulus spending. Well, we just said we're not going to spend stimulus spending anymore, and we can't afford it because we have $37 trillion in debt, and we're running a 6% deficit each year. We have to save money. So not so sure that you can just dial this recession in and then dial it back up. So the U.S., remember again, getting back to valuation, price for perfection, and things don't look perfect. Not even price. We're not priced for good. What if we just get good? What if some of this stuff works and some of it doesn't? That's going to be a negative relative to the expectations of the market. And then there are markets all around the world where the valuation and expectations are quite low, and things might be getting a little bit better.
Yeah. And I feel like there's been a big rotation in people's portfolios to Europe and the UK and China. Have you been seeing that interest from clients as well? Like for years, they've been pretty US focused, but now you're getting questions around these other companies and other markets?
We like seeing this direction of travel. It's a very, very new direction of travel, like a month and a half. So let's not get crazy on saying there's a bunch of momentum there. But and we should bear in mind the quantums. Trillions and trillions of dollars have flown into the US from overseas because that's the place to be. That is fear of missing out and wanting to be part of the crowd and wanting to get out of your own country that's in the doldrums. Perhaps we're seeing that start to flow back out, flow back into Europe, flow back into the UK and Scandinavia and Japan and Australia and Korea. That would be wonderful because we're overweight all those markets. And importantly, we're overweight in those markets because they're really freaking cheap. And because they're really cheap, and the narrative around them has been the UK is a basket case, Europe is a basket case, other countries just can't seem to get out of their own way. Again, those are the expectations that are in the valuation. So if you look at something like the UK, where the Prime Minister has come out recently and says, I'm going to reallocate money from social programs into defense spending. No one would have thought that was possible a year ago. That's a positive for economic activity. You're taking money from, may have been well spent on social programs, but it's non-productive. You're shifting that money into productive, building weapon systems, which, in and of themselves aren't fantastic things, but that is building out your industrial base and technology base. That's constructive. You're providing really good jobs. That's constructive. That's an up arrow on a very low valuation and poor sentiment market. And that's starting to spread within the UK. And Europe, something similar. I mean, Europe enjoyed their peace dividend, their 40-year peace dividend, by spending on social welfare programs, not on sharpening the spear, not on industrial policy to enable Europe to be incredibly capable and competitive without using coal and without having other energy resources, which are kind of the critical element of any kind of industrial policy. And you're now seeing them reverse course. So again, 10, 12 times earnings, less than half the multiple of the US, with expectations that are aligned with that, and little tiny arrows that are pointing up. Just those little tiny arrows that are pointing up has the Euro stocks outperforming the S&P by a mile thus far this year, which is what you're pointing out. But that is a gnat on an elephant's butt relative to the amount of money that could be flowing from A to B. And the U.S. market can take that. The U.S. market's so massive, it can take that money and absorb it into the system without the market going up 5, 10, 15-fold. What if that money tries to flow back out into Europe, into Norway, into the rest of Scandinavia, into the UK, into Australia? What if the Australians bring their money back?
Yeah, it'd be good.
The Mag 7 rolls over. It could be ridiculous what happens to gold.
Yeah.
And gold, typically, getting back to human nature, the average investor is a momentum investor. So the more something's going up, the more interested in it they are, regardless of valuation. So if momentum rolls over in the U.S., your momentum has now failed. So your investment thesis has failed. You tend to want to pull money from that. And you search for where there is momentum. Where's the momentum right now? It's in Europe. It's in gold. It's maybe in Japan. Economic activity in Japan is positively surprising. So these are much smaller buckets to try and capture that kind of momentum money coming out. And then it becomes the same self-fulfilling prophecy that we saw in the U.S. for 14, 15 years, where that money begets more vigorous activity, increases economic activity, increases industrial activity, increases the confidence of people who want to start up, the people who want to change for a better job, the people who want to get re-educated to get a better job or go out on their own, and that idea they had for a widget, they want to try and do that. They want to execute on that idea or that widget in Germany or in London. And you get that reinforcing cycle that may have the world call Europe exceptional one day. Why not?
Yeah.
We're all humans doing the same thing.
Yeah.
And, Europe can deregulate.
Yeah.
It is incrementally. You can't get more regulation than we have there right now. So that pendulum's swinging back the other way. But all these things that we observe about the U.S. are totally doable elsewhere. They aren't illegal. It's just there are impediments that need to get pushed out of the way.
Alec, I want to take a quick break here to thank you and the team at Orbis for supporting Basis Points and helping us keep all of our content free. For over 30 years, Orbis has been investing in undervalued and ignored global stocks. They're interested in long-term potential rather than short-term performance, and their international team of over 60 investment professionals concentrate on unearthing companies trading for less than they are worth rather than timing market trends. Orbis has applied the same fundamental long-term and contrarian investment approach since its inception and has over 60 billion Aussie dollars in assets under management. With the investment landscape rapidly changing and with valuations where they are today, Orbis's contrarian style and high value exposure can make it an effective diversifier in client portfolios. If you want to find out more about Orbis, head to the link in the show notes or the YouTube description. And again, a massive thank you to Orbis for supporting Basis Points and helping us keep all of our content free. Okay, Alec. So when we speak to a lot of fund managers, they say we don't pay too much attention to the macro. We're bottom-up stock pickers. But this whole conversation around momentum, I guess you can pick a great stock and you can be right, but the price cannot move in a market for a long time. And that's been the story for a lot of investors that have been focused on European stocks for a while. So now that there's momentum coming back in and the macro picture is changing. How much does that change your investing decisions or your portfolio weightings? How much do you pay attention to the macro when you're making actual portfolio decisions?
First off, I run the multi-asset team. It's a wonderful team in Bermuda, and they're all way smarter than I am, and I'm very proud to work with them. But running a balanced global balanced funds, you're forced to have two mandates. One is upside, trying to produce upside, and the other is worrying about risks. And I like to say, because this is kind of how it works in my brain, I worry about the upside during the day, and the risks wake me up at night. So it is a 24/7 activity being a moderate risk investor. In the context of something like Europe, where we've had, I don't know if we want to call them long-suffering names like Rolls-Royce and Siemens Energy, Prysmian, real European industrial companies that no one wanted, that have suddenly been discovered as being viable and cool. And to put it in full perspective, we were buying those names when ESG was in full flourish and they were dirty industrials, most of whom were providing product that were solving the problems of global warming, but because they made products, they were somehow miraculously considered to be ineligible for any kind of ESG or socially responsible fund. So we invested into that irony. But it took a long time for the investing world to come around to see things the way we did. There's a brief period of time as a contrarian where you actually feel comfortable. In the beginning, you're tortured because you're moving in, you're buying something that no one wants. You've got a choppy existence. You could be down 30, 40% because once something is completely fallen out of favor, there's no bottom because it's irrationally priced. And then when it gets expensive, you're anxious about selling it. So you have two pockets of anxiety. And then there's a brief period of time in the middle where you still have value. It's still certainly on the value end of the spectrum, and you have momentum. So you can see you have this wonderful, relaxing period where, Siemens is going up a couple percent a day, really solid. You can tell the money's flowing into it, but it's not got to the point of expense that makes you feel like you no longer own something contrarian.
So are you in that period now of comfort?
No.
Okay.
We're out of that period. And we're, we call it top slicing.
Okay.
So, every increase in Siemens Energy from now, we're just top slicing, and it's kind of a dividend, weirdly.
Just taking some money off the table.
Yeah, just shaving the top off it, but not bolting completely, because one of the weaknesses of value investors is you own a name for the torture period. And then once it starts working, you say, the multiple's going up, I got to get out. And you fail to capture the full rents for all the work you did. And typically, the real irony is when the value investor the value investor spends so much time over 4 years understanding this name, winds up getting maybe a double out of it, and then hands it off to a growth investor that hasn't done any work at all. They're just picking up momentum.
Yeah.
And then they get a triple.
Yeah.
Because the market becomes fascinated by it. So we've gotten better at time. We've gotten better over time at letting these things fully play out. So it's just a matter of just clipping a coupon, if you will, as they take a new level up. And we've done that with the European defense names, with the European industrials, as they've really lit it up.
This conversation is all around common mistakes and their simple fixes. So I want to go back to another common mistake. You mentioned it earlier that you play a game with your clients around are you truly diversified? And I'm not going to give you my portfolio and get you to play that game with me. But I want to talk about diversification, because I think it's probably the buzzword in investing. It's one of the first words you hear as you learn about investing. But I think a lot of people maybe don't understand true diversification or might be getting it wrong. So what is true diversification, and how can we check if we are truly diversified?
So let me just put it in the context of importance first. After the magic of compounding interest, diversification is the second miracle of investing. Because of what I said before, you're better off with two equally skilled investors that do things completely differently and produce the same result, because you've produced a much smoother performance profile, which if one performance profile, 10% return, say, per annum over 10 years, is very choppy and zigzags and goes up and down a lot, that's far less valuable than one that's very, very smooth. So if you could just get 10% each year, I mean, wouldn't you rather have that than up 20, down 10, up 30, down 20? Just much less stressful and therefore more valuable. Also, probably more tax efficient, depending on how taxes work for you. It is super valuable. We bring a completely diversifying approach typically to our clients, and increasingly so as value investors kind of keep rolling out of the business. There are less and less people that do what we do. It does require clients to sometimes get out of their comfort zone. If you're very comfortable with growth investing, where you get fed wonderful stories and you don't have to deal with icky companies that are down a lot, that can help people stay invested in with their growth manager. But we do think it's quite important to increase and widen the viewfinder, to bring in a different perspective from a skilled manager, if we are indeed skilled, and add that to the portfolio. And you don't need to go much further than that. As I said before, some people think they're diversified because they own 3 different funds that do the same thing, or 3 different managers that do the same thing. That is not. And they don't really think much about maybe bringing on a manager who does something different that's underperforming at that time, because they aren't comfortable with something that's underperforming, because they're afraid of being alone and wrong or being in something icky. We redouble our efforts when we're underperforming to try and let clients know that this is when you invest in a contrarian or any kind of investor. If you think a growth manager is fantastic, and you continue to have trust and confidence in them, and they've underperformed for 3 years, that's when I'd be interested in hiring them. And the same thing should be true for value or contrarian investors.
I think that's so important, to find managers that, even when things aren't going well, stick to their knitting.
Critical.
And I imagine a lot of fund managers would sort of let their scope creep to kind of chase what's working at any one time. So for advisors out there who are assessing fund managers on a daily basis, is it just about consistency of messaging and then that messaging matching the portfolio? Is that what we should be looking for?
Well, I think it's consistency of messaging, but it's consistency of practice. Contrarian investing is hard, and that there are fewer and fewer of us doing it because there are a lot of saber-toothed tigers out there right now for looking for contrarian and value investors. But it does cause many to shift and say, maybe this is not right. Maybe all the academic literature and what I've been taught and what I've been doing is wrong, and they shift and say, I'm going to become a quasi-growth investor, or I think typically when you see this, they'll say, I'm going to put a significant quality overlay on my value investing, and then they wind up owning all the growth stocks.
Yeah.
So they are now out, and they'll be out of business because they've underperformed. They've changed into something that's going to underperform next. It's called getting whipsawed, and I've seen this happen in my career many times. So from those on the outside looking in, you need to see a consistent application, and very consistent trust and confidence in your own process. And I mentioned before, you also need to see the financial backing there, because oftentimes, if the cycle's deep enough and long enough, which it has been, does that firm have the financial wherewithal and the ownership structure and governance structure to ensure that they're going to be around if you do a ton of work and make a commitment to that manager? That's critically important, and it's something that is often overlooked. And then the last is the team consistent? Are you seeing a bunch of turnover? Do they have enough of a skill set such that even when their style's out of favor, they're hanging in there? A Tiger Woods would call it grinding it out. When he didn't have his A game, he'd still finish the tournament in the top 5. They put the microphone on him and they said, "How was the tournament?" He said, I was really grinding it out. I didn't have my A game, and conditions weren't suitable for me, but I kept plodding away and I did a pretty good job. And oftentimes he said he was prouder of those events than he was of the events that he won with ease, because it took a lot more work and took a lot more effort.
Now, that's one, I guess, vector of diversification is sort of stylistic or philosophical diversification around managers, and not putting all your eggs in the growth manager basket. Another sort of vector of diversification is asset diversification. Yes. And at the Real Return Fund, you're not just looking at equities. So how should we be thinking about diversification across asset classes as well? And, to the earlier question around being truly diversified, how do we make sure we're truly diversified across asset classes?
Right. So importantly, while it is now, the Real Return Fund doesn't need to be truly diversified. The mandate of the Real Return Fund is to produce a moderate risk profile portfolio. And we've seen occasions just in the 15 years we've been running the fund where that has meant a portfolio with almost no bonds in it. So how can you run a balanced fund with no bonds in it? Well, bonds were reward-free risk for about 4 years. Why on earth am I going to buy a German Bund yielding minus 0.4 so that I can say I have bonds in my portfolio and it's diversifying? That's not diversifying. That's disastrous. So we can become very undiversified in order to execute our mission, and we have wide latitude to do that. It just so happens that as time has gone by, our net equity weight has dropped, and again, this is all in the mission of producing a moderate risk fund. That our asset weightings can change quite a bit, and the asset weightings change based on a competition for capital at the security level in this fund. It's important to disclaim that we don't have someone with infinite tactical market wisdom that rides on top of this fund that can, through a crystal ball, market time and asset time. And in fact, I would put to you that very, very few people in the world have that skill set, and no people that have that skill set would be working for anyone in this room, managing money for anyone in this room or anyone who will listen to this podcast. They work for themselves, and they probably live on a very nice island somewhere in the Pacific. It is an incredibly hard thing to do, and for those that try to say they can do it, God bless them. Maybe they will be the next one of 5 in the world, or maybe it's great marketing. We don't even try to do that. We use the competition between the stocks and the bonds and the hedged equity and the commodities to fight for position in the portfolio, and that's how we do our asset allocation. But if you think about how that has changed over time, when bonds were reward-free risk and we had no interest in them, we tended to hold, in order to produce moderate risk, we tended to hold lower risk equities and maximize hedging. So we run 17, 18% hedging, shorting the S&P 500, shorting the NASDAQ, shorting the Euro stock, shorting the ASI, and then owning things like electric utilities or telcos or what we're big in now, pipelines, names that have a lower beta and lower risk and more consistent earnings profiles, food stocks. That's changed over time, and I think when we came out of the box, we were running a 75% net equity weight. Roll forward to today, and that would have been almost 90% in equities, 15% hedging, and a 75% net equity weight, but still a moderate risk profile because of what those equities were and because of how the hedging worked. Roll that forward to today, we're running 52% net equity weight, so under the magical 60-40. We're running 10% in gold, and we've been running 10% in gold now for 4 or 5 years.
Wow.
And this is, I'll put my hand up and say I'd never invested in gold in my life until 2018, 2019, when government balance sheets got so far out of control that even I had to say there must be something better out there than this. We're running around 23% in bonds, fixed income at this point, so massive, massive difference in fixed income. And that is largely made up of very recent change from short-dated TIPS, Treasury inflation-protected securities, into longer-dated TIPS, where we're locking in around 2.5% real return plus inflation for the next 15, 25 years. That is a reflection of the fact that while nominal bond yields have come up, and as I talked about before, you could see Trump and Bessent trying to engineer a recession, which normally means go buy bonds. Bond yields drop in a recession. Well, they don't always. If inflation's going up, bond yields may not drop, which sets up a really nasty scenario for a government that has to keep funding itself, has to issue new bonds, and is trying to get the deficit down, and is already spending $1.4 trillion a year in interest payments. Relative, and to put that in perspective, the defense budget in the U.S. is $700 billion. So we're already spending twice as much on interest as we are on defense in the U.S., and that would only get way worse if you have a recession plus rates that don't come down because of inflation. So what do we look at that and say, we don't want to own nominals, even though we might go into recession, but TIPS will do just fine. You get the duration should be impacted positively by a recession, or may be impacted positively by recession, but really it's just about locking in a real return. Yeah. We think inflation could be between 3-4, could be 4 or 5%. So if inflation's in the middle of that range at 4%, plus we get 2.5% real, that's a 6.5% return that is guaranteed by the U.S. military.
Yeah. Yeah.
Not bad.
Not bad.
Unless you fantasize that the returns that we've been seeing in the market, in the U.S. market, 20% a year, are going to continue to go. They're not going to continue to go. The long-term average performance of equities globally is what, 6, 7, 8%, and it's only 8% because of the last 15 years. It's been 7%. What do we have to return, say, for the next 10 years to get that back down from 14% on a 15-year moving average to 7 or 8? We could be in for some years that people don't think are possible, like -5, -5, -5. You want to talk about a change in investing psyche?
Yeah.
Get a -5 for 3 years in a row in U.S. equities. That'll change everything.
Yeah.
And that's completely reasonable. That would take the earnings multiple, especially if you have a recession and earnings go down. That could take the multiple of the S&P 500 to 17 times. The long-term average is 13. We're still selling at a massive premium to history. and maybe the world that's supporting it isn't so great. We are, I don't know if hunkered down's the right word. We're continuing to produce a moderate risk portfolio. It's important to note to your listeners that doesn't guarantee a moderate risk outcome. We have no idea what Mr. Market is going to do with that portfolio, but at least we know the portfolio is moderate risk to start. And hopefully it winds up producing a moderate risk outcome, maybe even something better than that, maybe something that has returns that we can all be proud of.
Well, Alec, I really want to say thank you for joining us today. A bit of a dour note to end on, but I think a lot to think about, and a reminder that there are more asset classes out there than just US equities for us to diversify our portfolio, get away from the herd, and mitigate some of the risks that might be inherent in a lot of our portfolios. So thank you for joining us.
You're welcome. You call it down note, I call it exciting.
Okay.
So we're all good.
Yeah.
Thank you.
And thank you for tuning in to this episode of Basis Points. If you enjoyed it, make sure you subscribe wherever you're watching or you're listening so you don't miss a future episode. Speaking of subscribing, make sure you also subscribe to the Basis Points email. Now, if you're an advisor, a final reminder, this episode has been accredited by the FAAA for CPD points. So hit the link in the YouTube description or the show notes to complete the quiz and get your certificate. That'll do it for us for this episode. Thanks for tuning in, and we'll see you next time.